Hello everyone, and welcome to today's webinar. My name is Anu Sood, and I'm the Director of Marketing at Alessa and today's moderator. I hope you're doing well, and we thank you for taking the time to join today's presentation. Now, as many of you know, last October, FinCEN and the Federal Reserve Board invited comment on a proposed rule that would lower the threshold for which financial institutions would be required to collect and retain and transmit information related to certain transactions. The proposed rule would also apply to those involving convertible virtual currencies as well as digital assets with legal tender status. So with this proposed rule on the horizon, we thought it would be a good time to run a webinar on what the travel rule is and how to comply with this regulation. Now, our presenter today is Laurie Kelly. Now, Laurie has a 35-year career spanning the fields of accounting, finance, risk management, and regulatory compliance. Most recently, she served as the Director of Compliance for CoBank ACB, a $145 billion farm credit system institution, where she developed and managed the bank's AML, fraud, and economic sanctions compliance programs. She holds CAMS designation and CAMS audit specialization, and she also helped found the ACAMS Colorado chapter, where she served as the Executive Board Chair and Programs Director. And with that, I'd like to hand over the presentation over to Laurie.
Well, thank you, Anu. And again, welcome everyone to our deep dive into the FinCEN travel rule. Now, here's an overview of what we're going to cover today. Before we can dive deep, we have to start at the surface. So that's what we'll do. We'll talk about just what is the travel rule, why it's important, the information requirements it imposes, circumstances when it doesn't apply, and how it's enforced. Next, we'll go deeper, starting with the recent or fairly recent Notice of Proposed Rulemaking that will make some changes to the travel rule. And then we'll talk about one of my biggest pet peeves, which is the gaping disconnect between FedWire and travel rule requirements. And finally, we'll cover some of the finer nuances of travel rule compliance. We'll wrap up with some concluding comments and then answer any of your questions. But before we move on, let's take care of one more bit of housekeeping business. And that is, my presentation today is meant to help you understand the subject matter, but I am not a lawyer, so don't take anything I say as legal advice. Okay, now that we've got that out of the way, let's get started. So just what is the travel rule? Well, it started in early 1995, when the Board of Governors of the Fed and FinCEN jointly issued a rule for banks and other non-bank financial institutions relating to information to be included on funds transfers. Now, this rule really has two parts: the record-keeping rule and what's come to be known as the travel rule. The travel rule was really FinCEN's idea because it's in keeping with their mandate to enforce the Bank Secrecy Act. Now, the record-keeping rule and the travel rule do complement each other. The record-keeping rule requires financial institutions to collect and retain the information that, in turn, per the travel rule, must be included with funds transfers and then passed along or travel to each successive bank in the chain. But the record-keeping rule does serve some other purposes besides ensuring that information is available to include with funds transfers. And we'll touch on a few of these things as we go along. One last thing I want to call out here is that you see the terms transfer and transmittal used throughout this regulation. Do you know what the difference is between these? Well, it's pretty simple. A bank does transfers, and a non-bank financial institution does transmittals. So now you know. And for simplicity, I'm just going to use the word transfer most of the time here to cover both types. So what's the underlying objective of the travel rule? Well, as we all know, funds transfers have been the tool of choice for money laundering, fraud, and much, much more for decades. And FinCEN's job is to implement, administer, and enforce compliance with the Bank Secrecy Act. So it makes sense that FinCEN can require institutions to keep records that, according to them, have a high degree of usefulness in criminal, tax, or regulatory investigations or proceedings, or even in intelligence or counterintelligence matters when terrorism is involved. So therefore, the record-keeping and travel rule is really primarily designed to help law enforcement, to help them detect, investigate, and prosecute money laundering and financial crime by preserving that information trail about who's sending and receiving money through funds transfer systems. In other words, it helps them to follow the money. We know now that the travel rule applies to funds transfers or transmittals if you're a non-bank FI, but what exactly is a funds transfer? Well, this definition is actually very important, as you'll see when we get into the Notice of Proposed Rulemaking. The regulation defines it as a series of transactions beginning with an originator's payment order made for the purpose of making a payment of money to the beneficiary of that payment order. So let's look at an illustration at a pretty fundamental level. Here we have an originator who creates a payment order to pay money to a specific beneficiary. The originator delivers this payment order to his bank, which then passes on the details of this payment order to the bank where the beneficiary's account is located. The funds transfer is completed when the beneficiary's bank accepts the payment order on behalf of the beneficiary. Well, nowadays, funds transfers are electronic, and a wire transfer is the most common form of electronic funds transfer. At its essence, a wire transfer is just a message from one bank to another. And this message is passed through an electronic system such as FedWire, SWIFT, or CHIPS. And by the way, if you'd like to learn more about wire transfers and the various systems that are used to process them, you should check out the recording of a webinar we did in 2020 called Understanding Wire Transfers. And this is available on the ALESA website. Now, there are other types of electronic funds transfers besides wires, like ACH or point-of-sale systems. Now, although these are funds transfers, they are specifically excluded from the definition of a funds transfer in the travel rule, and therefore its requirements don't apply to them. In general, these are the types of electronic funds transfers defined in and governed by the Electronic Funds Transfer Act, otherwise known as Reg E or Regulation E. So these have their own set of rules, and the travel rule doesn't apply to them. Currently, these include ACH, ATM transactions, point-of-sale transactions, direct deposits or withdrawals, and telephone banking transfers, which I guess some people still use. Now, later on in our deep dive section of the presentation, we'll talk about another type of funds transfer that has previously avoided the travel rules requirements, but not for much longer. Just quickly here, I want to point out the various terminology that's used in the record keeping and travel rule, so you won't get confused if you have to refer to it later. The terms we're most used to when it comes to wire transfers and other EFTs actually comes from the Uniform Commercial Code's Article 4A, which also governs funds transfers. Now, throughout the presentation today, I'll be, for the most part, using this UCC 4A terminology because, honestly, it's just a lot more intuitive to me. And in case you're wondering, yes, that is how the regulation spells the word transmitter, which, according to the major dictionaries and my Microsoft spell checker, is misspelled. And just FYI, the term sender per UCC 4A refers to the person who's giving the instruction to the receiving bank, which would typically be the originator, but potentially could be someone else, as we'll see in an example a bit later. Now let's get into the heart of the record keeping and travel rule, the data requirements. The regulation breaks up the data on a funds transfer into two groups: data that is mandatory and data that, if the originator provides it, must be included. Now, first, the data that must be included by the originator's bank is the originator's name, and of course, remember the term used in the regulation is transmitter, the originator's address, their account number if they have one, the amount, the date, and the identity of the recipient's financial institution. Now, typically, a bank will automatically enter the originator's name and address information directly from a customer record. And this is because it's very important that the originator's name reflect the actual party initiating the payment order. Now, we'll get more into that in one of our deep dive sections a little later on. Now, let's look at the other group of data elements, those that are, in a word, optional, meaning that if your originator provides this information, you must include it. And that is the recipient's or beneficiary's name, address, account number, or other identifier, and then any other message or payment instructions. Now, these are what typically go into the free-form text fields on a wire transfer, like the originator to beneficiary information or OBI field on a FedWire. Now, even though these fields aren't mandatory per the travel rule, it does not mean that a bank can't choose to make them mandatory for their customers. And frankly, I think you'd want to at least make the recipient's account number be a mandatory field, because the receiving bank is going to have a lot of trouble posting those funds without an account number. At my bank, we made it mandatory for customers to provide the beneficiary's name, address, and account number on every wire transfer. Now, we obviously had no way of really validating this information, but at least it was there. And when it comes to beneficiary addresses, there can be problems because, well, people are lazy. When a customer can initiate a wire transfer through an online or a mobile banking system without human intervention, you may wind up with data in these beneficiary address fields like unknown or NA or X's, or in one very infamous instance at my bank, we discovered a customer had used for their beneficiary's address, quote, middle of nowhere. So if you can find ways to prevent this systematically, all the better, because remember, this information is meant to help law enforcement. But here's something else to consider when it comes to beneficiary information on wire transfers: suspicious activity monitoring. The beneficiary name and address on a wire transfer is critical to evaluating a transaction from an AML perspective. How else is your monitoring system going to detect unusual activity or patterns of activity of your customer without this data? Yet it's not required unless your originator provides it. I do find it pretty amazing that a regulation that's designed solely for the purpose of helping law enforcement to follow the money, which is part of a larger set of regulations requiring financial institutions to monitor and report suspicious activity, doesn't make a wire recipient's name, address, and account number mandatory. I mean, am I just crazy or what? Anyway, now beyond the types of EFTs that aren't subject to the travel rule because they fall under Regulation E, there are categories of funds transfers that are exempt from travel rule requirements. But this doesn't mean a financial institution can't choose to follow the travel rule for every funds transfer. And this seems likely to me to be the case because it's complicated to program these exemptions into systems. Again, no one's stopping you from putting more information than the bare minimum on any funds transfer. But just for the record, here they are. Currently, funds transfers that are less than $3,000 don't have to meet the travel rules requirements. Anytime the sender and the recipient are the same person, the travel rule requirements are not mandatory. So if I'm wiring money from my account at KeyBank to my account at Chase, KeyBank doesn't technically have to obtain and retain all the travel rule required information for my wire transfer. When a funds transfer occurs between two account holders at the same institution, the requirements don't apply. Now, we call this a book transfer because it doesn't ever need to go to the Fed. It's just an entry on the bank's books. And finally, transfers between any two of these types of entities are also exempt. Just to emphasize this one more time, there is nothing that says that you must follow these exemptions. Honestly, I think it benefits everyone when there's as much information as possible on any funds transfer, regardless of the dollar amount or who the originator and the beneficiary are. And a financial institution has every right to require their customer to provide more than just the mandatory information. It just becomes a policy of doing business with the bank. Frankly, if you set such a policy and a customer doesn't want to comply with it, maybe you don't really want them as a customer. So if there's a regulation, it should be enforced, you'd think. Well, throughout my years in compliance, I've always wondered about this when it comes to the record keeping and travel rule. The subject of enforcement also used to come up from time to time at my bank whenever a customer was reluctant to provide certain information for a wire transfer that they were initiating. Now, I have read through most of FinCEN's enforcement actions over the years, and I've rarely seen any that are solely pointing to violations of the record keeping and travel rule. There was an enforcement action back in 2015 against a cryptocurrency exchange that was primarily about the lack of an adequate AML program, but also mentioned failure to comply with, quote, funds transfer rules. But it is likely that just as a matter of course, financial institutions will populate at least the basic information on outgoing wire transfers and keep records, unless they're deliberately assisting in money laundering, and that's no doubt a much bigger issue. So all I'm saying is that there are no travel rule police out there scanning your wire transfers for travel rule compliance, unless maybe if you're in Italy, where they actually have a financial police. Isn't that cool? They've got fashion police. Why not financial police? Anyway, that being said, I do want to review one other very important requirement of the record keeping and travel rule, which relates to records retrievability. Now, your institution may be approached by federal, state, or local law enforcement, your regulator, some other regulatory agency, or by subpoena for specific funds transfer records. If you're the originating bank, the mandatory funds transfer information that you have to collect and retain, remember the originator's name and address, etc., has to be retrievable upon request based on the originator's name. Now, if the originator is your established customer, you also may have to retrieve this information by their account number if so requested. If you are the recipient's bank, same thing applies. Only you must, again, be able to retrieve the funds transfer information by the recipient's name. And if they're your customer, you have to be able to retrieve the information by their account number as well. Now, if you're an intermediary bank in the funds transfer chain, you're required to keep a record of what information you received on the payment order and make sure that you passed on every piece of data you received to the next bank. All funds transfer records must be kept for a minimum of 5 years from the date of the transaction per the record-keeping rule. Now, the rule just says if these records are requested, you have to be able to provide them within a reasonable period of time. Of course, they don't define the word reasonable, so I would imagine that that might be negotiable between you and whoever's requesting the records. But you may have heard of something called the 120-hour rule, or maybe you haven't. This is something that's within Section 314 of the USA Patriot Act. And it says that any information that's requested by a federal banking agency on any account that's opened, maintained, or managed in the U.S. must be provided by the financial institution within 120 hours, which works out to 5 days, after receiving the request. And it's not too big of a stretch to assume this could apply to funds transfer records as well. But from what I've read anecdotally, this 120-hour rule really hasn't been pushed too much by regulators, but it is out there, and you should really be prepared to respond to regulatory or law enforcement requests as quickly and efficiently as possible. Now, over the years, I've also received many IRS and civil case subpoenas requesting funds transfer records, and usually there's a fairly short window of time to respond to these. I mean, more than 120 hours, certainly, but not something that you'd want to just put off till you get around to it, if you know what I mean. Now that we've gone over the fundamentals, let's get into some deeper subject matter relating to the record keeping and travel rule, and we'll start with the latest notice of proposed rulemaking. On October 23rd of 2020, the Board of Governors of the Federal Reserve and FinCEN issued a joint notice of proposed rulemaking to amend the record keeping and travel rule regulations. This NPRM, as we call it, includes two major changes. One that may not be such a big deal, and the other, for some, a really big deal. The written comments on the proposed rule were due by the end of November 2020, so not really a very long comment period as these things go. The next step will be the publication of a final rule, but there's no set date for that. Now, according to regulations.gov website, there have been 2,882 comments received. I scanned through a number of these comments, and they're overwhelmingly negative, which isn't too surprising because nobody likes new regulations. But anyway, let's talk about these two major changes included in the NPRM. Now, the first one relates to reducing the $3,000 threshold for record keeping and travel rule compliance to $250 for cross-border transactions. And the threshold for domestic transactions would remain at $3,000. Now, you might not think this would be that big of a deal for most institutions because, as we were just talking about, it may just be easier to apply the requirements to every funds transfer regardless of dollar amount. But for those who do want to make that distinction, there's some interesting nuances to the proposed rule regarding what's meant by cross-border. So what do they mean by cross-border? Well, it's initially defined as a transaction that at a high level begins or ends outside of the United States. The proposed rule says that a funds transfer would begin or end outside the United States if, quote, the financial institution knows or has reason to know, I always love that language, that the originator, the originator's bank, the recipient, or the recipient's bank is located in, ordinarily resident in, or is organized under the laws of a jurisdiction other than the United States. Now, FinCEN says this reason to know would be based on the information in the payment order itself or otherwise collected from the originator. Now, the driving factor behind this aspect of the regulation change is just like the reasons for the regulation itself, law enforcement and anti-terrorism. A FinCEN analysis of our filings showed that cross-border funds transfers, and especially now lower dollar transfers in the $200 to $600 range, were being used extensively in foreign terrorism and narcotics trafficking, specifically fentanyl. So this change really makes sense from a law enforcement perspective. And in my personal opinion, if you haven't figured this out yet, I just don't think there should even be a dollar threshold. But the comments submitted on this aspect of the NPRM, as I said, were overtly negative, but much less voluminous than those on Part 2, and you'll see why in a minute. But interestingly, the American Bankers Association commentary, for example, was all about what a burden this would place on financial institutions. Really? I mean, I guess if a bank is trying to follow the threshold specifically, then yes, it would get more technical, much more technical, because now you have to make this distinction between a cross-border and a domestic transaction that's not always clear. And speaking from personal experience, it can, in fact, be very hard to do programmatically. For example, if a bank like mine has no direct foreign bank correspondent relationships, they have to use a U.S. intermediary bank for any cross-border transfers. So any wire transfer, outgoing or incoming, will go through a U.S. institution and therefore the Fed. So our monitoring software for both fraud and AML couldn't distinguish these transactions as foreign, or any of our transactions as foreign, because they were Fedwire transfers. And so therefore the system saw them as domestic. So we'll see what happens with this part of the proposed rule. Let's go on to part 2. So part 2 of the proposed rule is the one that's really creating all the drama. This new rule would make funds transfers involving what's called convertible virtual currency, or CVC, and other digital assets to be formally subject to the record-keeping and travel rule. Now, CVC is more commonly known as cyber currency or cryptocurrency, like Bitcoin. And as a brief definition, convertible virtual currency is considered a medium of exchange that has an equivalent value in currency, or it acts as a substitute for currency, but right now does not fall under the regulatory definition of money, or what's known as legal tender. And you may have noticed recently one Bitcoin went over $50,000, I think, earlier this week. A significant element of the proposed rule is that it now defines CVC as money, which makes a big difference because funds transfers using CVC can now legally fall under the definition of a transfer of money, to which the record-keeping and travel rule applies. And you'll see the importance of this in a moment. But really the why behind this proposed rule is the exponential growth in the use of virtual currency in money laundering, terrorist financing, organized crime, weapons proliferation, and so forth. And this is primarily because of its anonymity. Bad actors can convert illegal funds into virtual currency, then transmit it to any destination anonymously within seconds, where it can then be redeemed for cash again. This is the perfect mechanism for the layering phase of money laundering. Now I'd like to dive into some of the background of how this proposed regulation came about, and something else you may have heard of called the FATF travel rule. Now, while this presentation is not about cryptocurrency, I thought it'd be helpful to give a little bit of the background leading up to the proposed rule and how it ties in with something that happened earlier involving the Financial Actions Task Force, or FATF. Now, regulators in the US and globally were really caught off guard by how fast cryptocurrency took off. They didn't really understand it, and they didn't really have any protocols in place to govern it. Now let's start with October of 2018. FATF, at this point, published guidance that clearly defines just what are virtual assets and what they call virtual asset service providers, or VASPs. And they followed this up in February 2019 with a pretty far-reaching interpretive note to their recommendation 15, which is on new technologies, by the way. They did a public statement titled Mitigating Risks from Virtual Assets. This publication included 2 key proposals that caused quite a bit of an uproar from the cryptocurrency sector. One, it proposed that VASPs should be required to be licensed or registered, and it also introduced what's come to be known as the FATF travel rule for any funds transfer over $1,000, including virtual asset transfers. Now, these requirements match up point by point with the United States record-keeping and travel rule in terms of required data for funds transfers. So this was an instance of FATF copying what the US had already done, which is kind of unusual, but with a lowered dollar amount threshold. And in May of 2019, then, FinCEN put out guidance saying that CVC-based transfers processed by non-bank financial institutions may fall within the record-keeping and travel rule, on the grounds that such transfers involve a sender making a transmittal order. And they effectively remind U.S. money service businesses, which is an umbrella term that covers money transmitters like crypto exchanges, that they are subject to the Bank Secrecy Act and they need to comply with these regulations. Then, the next month, in June 2019, the FATF formally adopted the proposals from their 2018 guidance and incorporated them into their FATF 40 recommendations, specifically as an amendment to Recommendation 16 on wire transfers. And then, of course, in October 2020, the Fed and FinCEN joint NPRM comes out saying pretty much the same thing. Now let's move on to another deep dive topic, FedWire versus the travel rule. Now this is something I'm always amazed by. So we have FinCEN, which is a division of the U.S. Treasury Department, and we have the Federal Reserve Banks who own and operate FedWire, also a division of the U.S. Treasury Department. Yet FedWire does absolutely no validation that the travel rule is being followed. Literally, the only pieces of data you need to process a FedWire transfer are the sending and receiving bank's Fed routing numbers, the amount, and the effective date, as well as some other miscellaneous codes and so forth that help the transaction go through the system. But that's it. It seems like law enforcement could have a lot more information at its disposal if the federal government's actual funds transfer system made that data required. Because the thing is, if an originating bank doesn't put all the mandatory information, say the originator's name and address, on a funds transfer, then it's not the receiving bank's job to go back and demand it. No, the onus is on the originating bank to comply, and the receiving bank and any intermediary banks to just keep a record of exactly what they got from the previous bank in the chain. And as I said before, we don't have any travel rule police out there making sure the right information is on the wire. This is just something for you to consider. Now let's move on to another deep dive topic, aggregated funds transfers. Now, there are often situations where a financial institution aggregates or combines many separate transfer requests into one combined funds transfer. And again, I'm using transfer to refer to transmittals as well. Remember, it's all about what type of institution is doing it. Whenever a bank combines multiple parties' transfer requests into one single transfer, the bank itself becomes the originator for purposes of the travel rule. And on the flip side, if there are multiple recipients in this aggregated transfer, but all with accounts at the same receiving institution, then that bank effectively becomes the beneficiary on the aggregated funds transfer for purposes of the travel rule. Now, at this point, you're probably thinking, what the heck is she talking about? Well, this does happen fairly often, especially with money service businesses. So let's look at an example. Let's say we have a money transmitter in Texas who has several transmittal orders for different amounts from various people who are all sending money to relatives through one Mexican Casa de Cambio. Now, the Texas MSB will then bundle these up into a single transmittal order to their bank in Texas, where the beneficiary of this funds transfer will be the Mexican Casa de Cambio. Now, this aggregate transmittal order doesn't identify the individual originators or beneficiaries of the underlying transfers. It's just the total. The Texas bank sends this aggregate transmittal order to a Mexican bank, and the Mexican bank then pays the Mexican Casa de Cambio. The Casa de Cambio then pays the recipients based on separate transmittal orders that it received directly from the Texas MSB. So in this aggregation scenario, the payments are made really by a combination of, number one, individual transmittals of funds between senders and recipients, and number two, an aggregated funds transfer between the MSB and the Casa de Cambio. So what again are the record keeping and travel rule requirements for the US MSB and its Texas bank? Well, the MSB must keep track of each customer's individual transmittal order. And on these, the customer is the originator. So all the required information for the originator must be obtained and retained. And on these, the MSB is the originator's bank for these transmittals. The beneficiaries are the people who will receive the money, and their bank is the Mexican Casa de Cambio. The Texas Bank, on the other hand, keeps this record with respect to the aggregated funds transfer. Now, from their perspective, the MSB itself is the originator. They, the bank, are the originator's bank. The Casa de Cambio is the beneficiary, and the beneficiary's bank is the Mexican bank. Okay, so hopefully that's clear. Now let's move on to another deep dive topic relating to originator names. The originator's full true name is a required data element per the record keeping and travel rule. There's no question about that. And typically, the bank will automatically pull the originator's name and address information directly from the customer record. But you may encounter situations where your customer doesn't want you to use their real name. And changing this to satisfy the customer is a big, big no-no. One thing that could happen is where a customer wants you to change the name of the originator on a funds transfer to that of some other party. Now, allowing them to do this opens up all kinds of risks of fraud, tax evasion, and other kinds of illicit activities. Now, my bank's system would pre-populate the customer's name and address in the originator fields when the FedWire message was created, and the originators themselves had no control over this. So occasionally, we'd have a customer ask us to change that for them and put someone else's name as the originator on a wire transfer they were sending. Now, there wasn't really a malicious intent in these instances. It was always a commercial customer who was trying to send a payment on behalf of one of their affiliate companies that wasn't our customer. And there were a variety of reasons why our customer would do this for their affiliate, but in these cases, the underlying reason was that the recipient of the wire, usually a commodities futures broker, would reject and return any incoming wire from an originator that was not their account holder. So our customer would try to send a payment to the futures broker on behalf of their affiliate, and they put lots of information in the free-form text of the wire to say who it was for, their account number, etc. But the broker just wouldn't accept that and would return the wire. So our customer would then ask us to change the originator name from theirs to their affiliate's name. And we just politely told them no, but they were welcome to send the money to their affiliate's own bank account, wherever, and that company could do their own wire transfer to the broker. Well, there was lots of grumbling whenever this would come up, all about inconveniencing the customer, but we in compliance just stood our ground, and we refused to make any exceptions to this. Another situation you might encounter is when a customer wants to use some kind of code name or pseudonym instead of their real name. Now, this too is a really big no-no, and for purposes of the travel rule, it's actually prohibited. And I think you can imagine why. But when it comes to business customers, there is a little leeway. For example, a business customer that has multiple accounts and is wiring funds from an account where the account name reflects the purpose of the account is okay. So for example, XYZ Corp payroll account is okay to use as the originator name. And businesses can also use the names of unincorporated divisions or department names, similar to the account name example. A business may also use a trade name. Now, a trade name is what a business uses for advertising and sales purposes. It's sometimes referred to as a fictitious name. For example, McDonald's is a trade name for McDonald's Corporation. So a trade name is also okay to use for the originator name. And similarly, a DBA or doing business as name is also okay. DBA names are most commonly used by sole proprietorships. So if your customer's legal name is Sue Smith, DBA Sue's Flowers, it's okay to show Sue's Flowers as the originator name on a wire from their account. Now, you will, of course, have documented and verified any trade names or DBA names during customer due diligence when you open the account. Now, what about a joint account? For example, if Sue Smith and Robert Jones are joint account holders and they're sending a wire transfer to a beneficiary at another bank, who must their bank list as the originator on that wire? Well, you might be able to fit both names into the originator name field, but what if these two people have different addresses? There's no room on a Fed wire for two originators or two originator addresses. But fortunately, FinCEN gives us guidance on this, and they say just use the name and address of the joint account holder who ordered the transfer. Pretty simple. What about if your originator is sending funds to joint beneficiaries? Say your customer is sending a wire to the joint account of, I don't know, Kurt Russell and Goldie Hawn. In this situation, if your customer doesn't specify a single name, then you just have to pick one name and use it as the beneficiary name. And of course, in all these cases, you do need to keep records of all the parties, which you'd be doing anyway with the account records, so not a big deal here. Now let's do one more deep dive topic, which is funds transfers for non-customers. So if you accept funds transfer orders from other than established customers, in other words, non-customers, there are a few additional rules. Now, this most likely applies to money service businesses, as probably most banks these days don't do wire transfers or pretty much anything else for someone who's not an established customer. So let's look at these special rules for non-customer funds transfers. First, if the funds transfer order is made in person by the originator, you must verify their identity, and you must obtain and retain a record of that person's name and address, the type of identification that you reviewed, and the ID document number, like a driver's license number, as well as the originator's tax ID number. Or if they don't have one, you're to ask for an alien ID number or a passport number. Or if they don't have anything like that, just keep a record that they didn't have anything. Now, if the non-customer funds transfer order is being placed by someone other than the originator, you have to verify and keep a record of the identity of that person who's ordering it, their name, address, identification type and number, and tax ID number, or alien ID, passport number, etc. But they must also provide the tax ID number of the actual originator. So if it's an individual, that person's social security number, alien ID, and so forth, or if it's a company, its employer ID number. Now, if the person placing the order says that they don't know what this is, then you're just supposed to make a note of that. You also must keep a record of the method of payment for the funds transfer, like a check or a credit card transaction. And why you aren't required to do this in the first scenario, where the originator is placing the order, doesn't really make much sense, but I'm sure that this is just a normal course of business for any institution that's doing non-customer transactions. All right, now let's recap what we've covered today. First, remember that the rule we've been discussing is a two-part joint regulation under the Bank Secrecy Act issued by the Federal Reserve Board and FinCEN, the record-keeping and travel rule. And with that in mind, I want to reemphasize that record retrieval is just as important as record creation. It's the record retrieval aspect that's probably more likely to cause problems for your institution. So make sure you're keeping full records of all outgoing and incoming funds transfers for 5 years, and that you can retrieve these records either by account number or originator name or customer name. Next, remember that those exemptions to the rule, like funds transfers under $3,000, are not mandatory, meaning you can, if you so wish, freely and fully comply with the record-keeping and travel rule for every funds transfer you send or receive, no matter the dollar amount or the parties involved. But consider the impact as well on suspicious activity monitoring if your originator isn't required to include the beneficiary information, their name, address, account number, on every wire transfer. Watch for what's next, again, with this latest Notice of Proposed Rulemaking that impacts both cross-border funds transfers and the virtual currency industry. Now, no one knows how long it'll take until we see a final rule. It took FinCEN nearly 2 years to get from NPRM to final rule on the beneficial ownership, or as we know it, customer due diligence rules. As with any NPRM, there's been lots of pushback, but typically FinCEN gets its way regardless. Remember not to let your customer use another name for the originator on their outgoing funds transfers. This can be a very slippery slope, no matter how innocent or legitimate the request may seem. And finally, if your institution sends or receives any aggregated funds transfers or transfers for non-customers, review your processes to make sure you're in compliance with the special rules for these. Well, thank you so much for participating in the webinar today, and I hope it's been valuable to you.
So with that, I'd like to thank everybody for taking the time to join today's presentation, for Laurie for doing another fantastic presentation, and for Nicole, who is in the background answering everybody's questions. Thank you very much. We hope that you enjoyed today's presentation and that you will join us in our upcoming webinars. And with that, I'd like to close the presentation.